Why should not the goal be to maximize profits? There are two main reasons for not using profit maximization as an operational objective. Managers often refer to some measure of accounting earnings, while stock market traders talk about earnings based on market values. Profits ignore the time value of the money and the risk taken to obtain them. Accounting gains do not take into account neither the time value of money nor the risk between different alternatives. Maximizing profits ignores the difference in value. Agency cost. Do managers and shareholders have the same goal? Shareholders hire managers or administrators to exercise the management of the company, in which the question that arises: do the managers act according to the interests of the shareholders? The reality is that in this type of situation, you can always generate conflicts that generate the so-called agency costs. The most common agency costs are the indirect ones, although there can also be direct ones. If the administration does not carry out the investment, the shareholders will be lost the opportunity to increase their wealth. This is called an agency cost. Areas in which the finance executive performs. The financial executive can perform in several areas, and you can define three. Corporate finance is about the financial executive manage and he manage own funds, while in the financial investment and capital markets, it manages third-party funds. That is, the three areas use the same principles and involve the same financial transaction. Corporate finance and financial management. The main decisions fall into three categories. Decision of investment. It is the most important decision of the firm since they deal mainly with the assets that the firm must buy, respecting the old principle that the value of this should always be greater at its cost to increase the value of the firm. The most frequently asked questions are: should we rescue more money from the bank or obtain it through the issue of obligation of shares? What are the tax advantages of each type of financing? Should we pay a cash dividend to shareholders? If this is the case, how much? Or should we use this money for repurchase of shares? Short-term financial management is more linked to day-to-day decisions and more operational functions, while corporate finance appears to be used for long-term planning as the main financial decision. Financial investments. This area is where transactions are performed on account and order of a third party who does not belong to the organization but is a customer of this. For example, an investment analyst at bank evaluates investments in securities such as bonds or shares of a company. Capital markets. In this area, where a series of financial instruments called securities titles are traded. These markets can operate without physical contact through the electronic transfers, telephone, or fax.
Globalization of financial markets. We live in a world where financial transactions have become globalized today. It is much easier to move capital quickly to other parts of the world, and with lower transaction costs. Global companies are becoming more common, and names like McDonald's, Coca-Cola, Sony, and Microsoft are known around the world. The pursuit of low-cost capital has become an international game for multinational companies. The advance of information technology makes information flow so fast that international events impact of economies. The principles of exchange trade-off between risk and performance. We say that there is a relationship between risk and performance. It is normal to find individuals who have aversion to risk, that is, to dislike the mere possibility of a loss. If an individual is going to accept greater risk in an investment, he will demand a higher premium in the form of a higher expected return. It is no coincidence and investments that have higher expected returns are more risky. This relationship between risk and return is like a budget constraint. There is a possibility in the market of exchanging to so many units of risk for so many units of performance, no matter how the individual wanted that exchange rating. The principle of diversification. The principle of diversification works in finance as a kind of balance. If we spend all our money in one action, we put everything or nothing, we expose all our wealth to what happens with the price of such action. But if we divided our investment between more shares, our wealth decreases its exposure to risk, because a decline in the price of some shares will be offset by the risk in the price of others. This is because the price of the asset is imperfectly correlated, since when some others go down, or unless they do not decrease in the same proportion, with which the diversification has even effect diminished and the variable on the return with respect to average value. The principle of efficient capital markets. An efficient capital market is one where no investor pays for an asset neither more nor less than its worth. Specifically, that principle and states as follows: the market values of financial assets that are regularly traded off the capital markets relate unavoidable information that it adjusts quickly to the new information. In defense of the principle, we must point out that an efficient capital market transaction costs are low compared to transaction costs that exist in the market with real assets, real estate, machinery, or traded. The size of capital market in some countries is very large. Only the New York Stock Exchange trades more than $10 trillion per day. Therefore, there are a lot of participants and the competition is intense. If there a price difference, they could be eliminated quickly by an arbitration process. It is more impossible to be a millionaire in a capital-efficient market where there are only two ways to make money: risking and money and having information that the market has not yet discounted. The opportunity cost principle. The investor in general has a series of alternatives with risk and social returns. When you choose to invest money in an asset, you immediately create an opportunity cost the chance to invest in another risk alternative, and comparable return. The value principle of a good idea. New product or service can create value, so if you have the imagination for a good idea, this could become an excellent return. Most good ideas are linked to physical asset markets, since unlike financial assets, they are more likely to be unique. Finance represents that branch of economic science that deals with everything concerning value. The goal of finance is to maximize shareholder wealth. In this way, investment decisions and financial decisions must add to the company as much wealth as possible. The shareholders hire the directors to exert the management of the company. The immediate question that arises is, do managers act according to the interests of shareholders? The reality is that in this type of relationship, conflict can always arise. This conflict often generates no agency costs. The most common agency costs are indirect costs, although the many also be direct costs. The fact that managers and according to the interests of the shareholder depend on two factors: the way and in which they are remunerated and the control of the company.
Retained utility. Separation retained earnings from undistributed reserve of profit or when dividend into shares. Often company allocate certain reserve for contingency such as the renewal of a good of use, the realization of future investment, the coverage of losses of some other specific accounts. This actually results in an account transformed from the rentability earning account to the reserve account, generally only a qualitative change in equity. Statement of evolution of net asset. This state short of the shareholder equality as involved. In general, the change that follow are adopted to add to the initial equality. The gain or loss of the year, subtract the payment of bills to syndicate and director, cash dividend, and some other concepts that implies a change in equality. Payment of dividend. When dividends are distribution in the form of cash dividend, the net worth of the company is reduced, which causes the incremental in the book value of the stock. Under normal circumstances, such a reduction in book value is accompanied by a proportional reduction in the value of the share in the market. The working capital. Working capital represents the difference between current assets and short-term liability. The company operation into short-term by inventories that it transports or not and then sell to its customer with a profit margin. In this process involving a series of work assets, such as cash, inventory, and credit that the firm grant to its customers. In the same way that the company credit its customers with their sale. When it purchases inventory, it obtains financing from its suppliers. Also, company maintaining short-term debt with the treasury and sometimes also bank debit The result of that process determines a balance that is the working capital. Summary: complete comprehension of financial statement is indispensable for the finance executive in quality terms. An economic and financial category of the company end up being reflected in them. We must know how to interpret the not only to know what has happened in the past but also become as we will see in the next chapter. We must know how to produce information toward them. Cash flow is the category used in corporate finance to determine to the evaluate of assets. This can and should be obtained from the financial statement and the signature, integrating the patrimonial information with the economy. There are several disjoints in accounts that separate the book value from its market value. For this reason, we have alerted you to service of the Trongor. This chapter, financial statement, gave us great help if we can know how we use them, what their danger may be, and what their limitations are. Finally, financial decisions are always surrounded by days. The commonly determined tax or fiscal balance is an ideal construction was basic in the accounting result. The tax balance of the comprise the same operation for the given period, but normally the final result of the same year different from the balance sheet. These differences are due to value method limitation on the deduction of certain expenses that can be described as temporary or definitive. In some cases, the tax effects of the financial decision can have a dramatic impact on evaluation, as we will see in the one for the capital structure.
The cash flow statement. In this table, we can see that the cash flow statement for the year 2000. We start from the operating result of the firm. Then all the decrease in assets are subtracted or added up, and all increases in the liabilities are added or subtracted. Finally, cash dividends payments are subtracted, and we obtain the cash flow generated by the company in 2000, which is the cash flow or net cash flow. This method is called indirect because it reconstructs the cash flow from the difference between assets and liabilities from one year to another. The reasoning is simple and based on accounting conventions. For example, increase in commercial debts add up because without an inflow of money for the company, an increase in fixed assets or other assets such as accounts receivable and inventories are subtracted because they represent disbursements. As another important in the export of cash flow generated by operation, investments, and the last section will be reserved for financings. There are many details in the making of cash flow in terms of organization and sports. Balance sheet represent the financial reality of the company. The role of financial statements as information to obtain measures and profitability and value of the company. The financial statements contain historical information. The report of the first financial statement is still today the document that best summarizes the financial activities of the firm, and the fears that solicit banking analysts, consultants, and researchers when they seek to analyze the financial economic situation of the company. They may also have major limitations in communicating the actual state as there are discrepancies, especially in the case of fixed assets, that the values company do not match in the values of the books and the market value. Tangible fixed assets, valuation or liquidity. They can be two types, tangible and intangible. The tangibles, as an example of plant machinery, these are recorded on the balance sheet and the historical cost. And the time the market value is similar to his book value. As time passes, the book value is stable along with the historical cost of accumulated depreciation. There are some assets are the lands that as time goes by gets a significant revaluation. Generally, they represent a great transaction cost when they are sold, but the sale process is more complicated. Since the increase its value increase the complexity of the same. And the intangible assets that do not appear in the balance. Intangible fixed assets may still be less liquid than the tangible assets, since there is no market to trade them. On the other hand, it is difficult to value them for different situations, such as the reputation of the company, strategic positioning of the value of the brand. This includes the advertising phrases of each of the company. Inventories, first in, first out, and last in, first out. The FIFO, first in, first out method could cause the final stock to the value of the last price, presumably higher by inflation, so the profit increase, and the disadvantage would be that more that taxes will be paid. With the last in, first out method would be exactly the opposite, because since the final stock would be valued at the first price. All these situations make the final extension of inventory them into a category to which you have to pay close attention when analyze a balance sheet. Transitional investments. In general, this item will include time deposits, public or private bonds, common funds, and other similar. In general, its book value should approach the market value. Credits by sales. This is another area when there may be problems. Commercial credit is used to companies to facilitate sales of their products and in general give payment facilities work as an incentive. But this item can be difficult because they hide bad debts. Depreciation methods. Companies use fixed assets such as a plant or machinery to produce goods. These assets lose their value with the use and the passage of time, or technological obsolescence. This value is a cost of production, and therefore must be reflected in the income statement account. use various methods to reflect depreciation in order to spread the cost of the good over what is considered useful life. In general, the methods that bring out accelerate depreciation punish the result of first years, with the consequent saving of taxes. The choice of the depreciation method affects double in the financial statements, since it is reflected in the balance sheet based on the effect of the value of fixed assets and also of the charge to results.